Good morning, Bowtie Nation. Thank you for joining us for another one of these Monday market updates, 9 a.m. every Monday, getting you ready for the market week. See a lot of great citizens out there in the Bowtie Nation. David, good to see you there. Multiverse, a drunk bee, which is awesome. I love that. Russ from Romania. We've got Switzerland in the house. Melanie Struck, Melanie and Ambrose, both there. Longtime members of the Bowtie Nation. In fact, they're not just citizens; they're probably ambassadors, vice presidents at this point. So thank you for joining us. Got a really big week for you this week. Important week, of course. Last week, the market just exploded higher with that lower than normal or lower than expected consumer price index report. We did preview it last week, said that on a month-to-month basis, there was a good chance that was going to come in lower than expected. It did. It came in at 7.7. Really gave the markets the impression that inflation is finally starting to come down and that the Fed will, in fact, go through with that pivot where they slow down their rate hikes and then eventually pause. And of course, that would be good news for stocks. But is the all clear really signal really been signaled yet? Are we in the new bull market? Stocks zoomed 6% plus in just 2 days. In fact, the Nasdaq had its best day best 2 days in 14 days. But we're not necessarily just there yet, and I'm going to show you why. I'm going to show you some data that points to the fact that we're not quite out of the bear market or the stock market crash just yet, and how to invest around that. There's no problem with making some money here over the next week as stocks maybe carry that momentum a little bit higher. But you do want to have some cash ready, and you do want to have some other alternatives and opportunities ready for when that bear market rally does give in, and we do continue those lows once again. Not sure that we're going to see lower lows, break through that 3,500 point that we saw last month in October. But we will see lower than 4,000. I'm saying. So we're going to look at that. We're going to go into the data. Right now, we got to talk about BlockFi and crypto. Of course, crypto was the big news last week. The implosion of the FTX platform, Sam Bankman-Fried, all that. FTX had lent out half of its customer funds to its own trading firm, Alameda, which I don't know why that's allowed or why regulators haven't stepped in yet and to place some kind of regulations on this market. That's really what we need. But unfortunately, it also looks like it brought down the BlockFi platform as well, which is the platform I've been using, the platform I've talked about on the channel. And in fact, the platform I still have $70,000 on. So, if you've got your money locked in BlockFi, I'm right there with you. Right now, they are halted on withdrawals. Because of those liquidity issues. The problem is, FTX had supposedly come to the rescue and agreed to buy BlockFi earlier and was going to bail them out, and everything was going to be fine. Of course, now with FTX down, then BlockFi is down as well. Nothing is decided yet. I am really optimistic in the fact that BlockFi does have that credit card business, which rumors are that there is kind of a bidding war in the process for that credit card business. Basically, all of us that have credit cards through BlockFi to get those Bitcoin rewards. A lot of other companies are bidding on that segment, that business, to translate or to migrate those users and those credit card users onto their business. That is a very valuable segment of the business. So hopefully BlockFi gets enough out of that, out of that business segment. If they sell it, then they can unlock withdrawals and they can make everyone whole again. But again, I'm there with about $70,000 in assets on BlockFi frozen, just like a lot of people. I'm hopeful that they unlock it, but we can never be sure. And this is the kind of thing, this is kind of risk you take with a lot of these new platforms and a lot of these new assets. Now, what I do think is that I'm still holding to those longer term Bitcoin and Ethereum and cryptocurrency targets, right? What most people don't understand is this does not change that fundamental use case or that fundamental reason for Bitcoin, for cryptocurrencies like Ethereum. Now, I'm not talking about all the shit coins like, you know what they are, all the Shiba Inu and Doge and the literal shit coins, right? The coins that have no other purpose than to trade and to speculate. What I'm talking about here is the use for Bitcoin is currency transactions, is international transfers, things like that, right? As an alternative to foreign other currencies. The use case for Ethereum is through the blockchain, and both of these are used on the blockchain to validate those blockchain transactions, right? A lot of people don't understand the actual basis behind all this is that blockchain technology and how it's being used in every single industry, right? From healthcare to technology. All those industries, finance, the blockchain is being used to facilitate transactions, transfers in real estate, things like that. And it is really, a breakthrough technology. And that isn't going away. Okay, the blockchain will continue to be used as a technology and as a resource in all these industries. And it's only going to grow faster. Just the difference in security and the difference in transaction speeds and fees for these kinds of transactions is way ahead of what we used to do, right? It used to take 30 days to clear your real estate transactions, right? Well, with the blockchain technology, you can do escrows, you can do all that kind of things instantly and for a fraction of the fees. So the use of these cryptocurrencies, Bitcoin and Ethereum, isn't going away. Okay, those coins, those cryptocurrencies, are used in those to validate those transactions on the blockchain. Okay, so you need those two coins, and that use isn't going away. So as an asset class, the need for these cryptocurrencies is only going to develop higher, in the future. What is going to have to happen is there's going to have to be regulation on these. Okay, there's going to have to be regulation, and it's really, Congress and the SEC has just dragged their feet and really dropped the ball on actually putting some regulation on here, so we don't have blowups like FTX and SBF, right, where they can't take half of customer funds. FTX had half of its customer funds it had lent out to its own trading firm. Okay, so really kind of double dealing with customer funds. Lent out half of its customer funds to Alameda to trade on, right? And of course, that's where the implosion came from. When those trades went bad, then Alameda and FTX didn't have the capital to support those withdrawals on FTX. A lot of these platforms is the same thing. They don't. They're trying to do these. They're trying to be cute with customer funds and these yields and some of these other things. And it just needs to be regulated more like a bank, right? Where they have a reserve set aside to cover customer funds, where where customer funds are protected with some kind of an insurance. So the industry needs to come forward with some kind of an insurance plan to cover these and bail out these funds or these platforms when they do get in trouble, and they need to be regulated to that, so that this kind of thing doesn't happen, because these are a legitimate asset class, okay, and a legitimate investment. If you don't get these bad actors like FTX, like Sam Bankman-Fried and that kind of thing. So, like I said, I'm there with you on BlockFi. Hopefully they get enough money out of that credit card business to make customers whole, and we'll see where it goes from there. I do want to start on our main topic this week, because this is the question everybody's asking, right? Is the bull market, or is the bear market over? Is the new bull market here, and how to invest in that? How should I take advantage of the new bull market if it really is here? Right? The Nasdaq was up 9.3% just in the final 2 days of last week. Right? That hasn't happened for 14 days. Not even in the rebound from the 2020 from the pandemic crash. Not even in the pandemic there. It hasn't happened since 2000, right? The Nasdaq was up that much in just 2 days. And in fact, there's only been 9 times in the past 30 years when it's been up so much, okay? So, real market consensus or market enthusiasm that drove that. And what we saw was the CPI. I want to show you this chart here. The CPI came down. We see here, obviously, the consumer price index. This is what we're all talking about. Peaked out at 9% there in earlier in the year, in September, I believe it was, has come down gradually, right? But it was really that fast come down to 7.7% that surprised the market. The market was actually expecting 7.9% on the CPI. So coming down, that 7.7%, and how it came down, some of the areas where it did come down in really surprised the market and really led investors to believe that yes, the Fed can eventually slow down its rate hikes and its peaks. And what we're talking about here This is a tool that I use. I talked about it on the channel before. The CME Fed Watch tool. Okay, if you ever want to know what the market is expecting for those interest rate hikes by the Federal Reserve, then you can come here and you can see the probability baked into the market for how much those rate hikes are. Okay, so what we do is we scroll down here, and this Fed Watch tool, this is going to show you across the top here the meetings, the upcoming meetings of the Federal Reserve. Right, you get the next one here in 14th of February or 14th of December. You got another one in the 1st of February next year, 22 March, 3rd of May, and so on. Across the top here, you've got the current rate target. Okay, remember what the Federal Reserve does, it has its Fed funds rate, which is the rate, used by banks, used to overnight lending, that kind of thing. And it manipulates that rate, or it has a target rate. Here we have a target rate of 3.75 to 4.0. That's 375 basis points to 400 basis points, but that's really 3.75% to 4%. And what it does in its transactions is it targets that rate. It tries to keep the federal funds rate in that range. And of course, what this does is it influences all other interest rates, right? And it influences treasury rates, it influences mortgage rates, car loans, things like that. And by doing that, it can speed up or slow down the economy, okay? Because those interest rates are a cost to borrow money, it's a cost of doing business. If interest rates are really high, people can't afford to buy a house, people can't afford to buy a car, businesses can't afford to issue bonds and grow and things like that. So as they increase the interest rates, it slows down the economy, and the thinking is that's going to slow down inflation, which is what they've been trying to do. If it decreases interest rates, then conversely, then it's going to help the economy, right? It's going to it's going to make those loans cheaper, and people are going to borrow, companies are going to borrow, and the economy is going to grow. So what we see here, the current target is a high of 4%, right? Here we see we are in the 14th of December Fed meeting, okay? And we got the odds baked in to what they're going to do, right? We see here 425 to 450 is 80%. So right now, the market is saying there's an 80% chance that, or 80% probability that the Fed raises its target rate by 50 basis points, or 0.5%. Okay, so if it's top target of 4% right now, top target of 4.5%, or 450 basis points there in December, that's 80%. Well, it's really, what we saw last week is really the change to those expectations, okay? Because we see across the bottom here, we see these are the expectations now, 1 day ago, 1 week ago, and 1 month ago. Well, just 1 week ago, it was only 52% that they were going to do that 50 basis point hike, that 0.5% hike, and it was 48% that they were going to do a 75 basis point hike, right? A much higher, another 0.75% interest rate hike. That was 1 week ago before those CPI numbers. Now it is the market consensus is that we're only going to get that 50 basis point hike. So the market does believe the Fed is going to slow down on its rate hikes as of next meeting. They're no longer going to be hiking by 75 basis points or 0.75% a meeting. They're just going to slow down to 0.5%. We can go out here to February. Okay, so what does the market expect for February now from the Federal Reserve? Again, the market's expecting it basically to be about 450 basis points, or 4.5% by the end of the December meeting. Now we're saying there's about a 44% chance, or a 44% probability that they only raise it 25 basis points, or 0.25% here in the February meeting. That would be this one right here, or another 47% probability that they raise it another 50 basis points, or 0.5%, right? And again, you look at the difference, the change in those odds. Just as of last week, before those CPI numbers, it was 50% that they were going to raise it by half a percent in the February meeting, and a 30% chance, a 30% probability they were going to raise it by another 75 basis points, right? So another ginormous Fed hike there in February was expected, and now those odds are all the way down to about 8.7%. So it does look like the market has come to that thinking that the Fed is now, as of this next meeting, is going to slow down to just 0.5% interest rate hikes, and is going to slow down even further in February, and likely, in February that could be the last interest rate hike by the Fed in this cycle. Okay. And of course, that would be good news for the economy. Again, business earnings, because those higher interest rates are more expensive borrowing. And when that stops, the consumers and businesses can breathe that huge sigh of relief that interest rates aren't going to be going up too much anymore. And of course, we've got all kinds of data and everything to support the idea that the market is going to bottom. Around that time, we do have this. I want to show you this chart by Mark Holpert there on Market Watch. This was behind a paywall, but I got it for you here. What we're looking at here is, this first column is start of the rate hike cycle. So the start of when the Fed starts hiking rates, and then the end of the rate hike cycle. Okay, the end when they finally stop increasing interest rates, right? So we got those two columns. We've got We've got the last 6 rate hike cycles here back to 1984. Now this third column is what we're looking at here, the days in advance of cycle's end that the S&P 500 hits its low. Okay, so what this is saying is how many days before the Fed stops raising interest rates does the stock market bottom out? Okay, when is the bottom? When is the bottom of that bear market? When is the bottom? When do stocks finally hit their bottom? And how far in advance of the end of the rate hike cycle is that? Okay, because of course we always know that the stock market is forward-looking. Investors are always looking further out and saying, okay, what's the economy going to look like in 6 months? What is the Federal Reserve going to be doing in 3 months, in 6 months? And how is that going to affect stocks? Because we want to be ahead of the game. We want to be front running those changes. So generally, the stock market does bottom out before the Fed stops its interest rate hikes, according to this data, right? According to the last six cycles. Okay, and we can see here, 1984 it bottomed 16 days. 1989 it bottomed 176 days. So the average is actually about 57 days, right? And this is important, obviously, because it would mean that the market might not have bottomed just yet. If we are expecting the Fed to stop its interest rate hikes in February of next year, then this average of 57 days before the cycle ends, that would put us somewhere in the last week of December. Okay, so we are now 105 days out from that February 2023 meeting by the Fed, which could mark the end of the central bank hikes. If this average holds at 57 days or anything like that, then we could still see a market low. We could still see a bottom to the market. Now, of course, the problem here is that this variation in these 6 rate hike cycles. Whenever you look at data like this, or people try to use the past to predict the future, you always got to be wary. You always got to wonder, okay, how many data points is this? This is only 6 cycles. So it's always going to be different, right? There's no bear market that looks exactly like the past. In fact, the very few of them are ever going to look like the average even. You can look at this for some guidance, but, if you take this, the cycle in 1989, the stock market bottomed 176 days, right? More than half a year, more than 6 months, right? Before the almost 6 months before the rate hike cycle ended, right? So that would have been, well before now. Some other ones here, 55 is pretty close to the average. 81, that would have been about 3 months. So, that would probably be right about now, maybe a couple weeks. 16 days here in 84 and 86. So that would be, in February yet where the market bottoms. We've got another chart here by the by Bank of America that we can look at, and this shows the Fed historically cut before each market bottom. Okay, federal funds rate in blue here. So the Fed funds rate is what we were looking at with the Fed Watch tool. That rate that is manipulated by the Federal Reserve with its interest rate increases, and then market bottoms here are shaded, in light blue there. And what we can see here, looking at back to 1974, is that a lot of times is often the market bottoms after the Fed actually starts cutting rates. The Fed, obviously, that would be intuitive, right? If the Federal Reserve sees the economy falling, sees the economy slowing down, if the stock market is part of that economy, it's It's asset values, and really the wealth of a lot of people in the economy. If that starts falling apart, then the Fed is going to see that, and it's going to try to prop up the economy a little bit by cutting rates. So what you see here is the fact that a lot of times, the Fed has started cutting rates, before the market has bottomed. So of course that would push the bottom out much further, right? If the Fed is still increasing rates and still expected to increase rates through at least February of next year. They are not even close to cutting rates. Okay, they are probably at least 6 months outside of February from cutting rates. Depends on how bad the economy gets. If inflation does come down quite quickly and the economy does fall apart, then of course the Fed is going to step in and it's going to cut rates even faster. But it could be possibly even into 2024 before the Fed starts cutting rates. So we and we can use one more chart here before I want to put all this together. This is the bull and bear markets research by McKinsey. Okay, we do see that they've what they've done here is they've measured the length of bull and bear markets back to 1956, so quite a few decades here, and they found that the average length of the bear market was about 9 months. Right, bear markets from peak to trough was about 9 months. The average loss on the stock market was about 28%. Right, which that would be pretty optimistic here, right? If we were looking at an average peak to trough of 9 months and 28%, that would put us right around September when the market should have bottomed on that average. It would have put us right at where the S&P 500 hit its October low. Okay, in October, that October 13th low of 3,500 intraday, that was 27% down from the January peak. Okay, which actually would be very close, eerily close, in fact, to this 28% average. And that 9 months would be right around there in September. So, we look at all these numbers and this research, not to confuse you, but just to give some sense of certainty in what can ultimately never really be certain, right? Nobody knows when the stock market is going to stop falling, when the next bull market can start. We can look to numbers like this and research like this to get an idea of, how it might be reacting to different news, the end of the Fed rate hike cycle, things like that. But because of that, because it is ultimately uncertain and you cannot be sure for anything, it's always a good idea just to bring it back to that basic idea of investing. And what is that? That is stock market earnings. Okay, when you buy a stock, you own a piece of that company, and by that you have a right to those future earnings of that company. Okay, so the very most basic idea of stock investing is to own those earnings. So you got to look at, okay, how much are you paying for those earnings? That price to earnings ratio, the price to sales ratio that we look at, what are you paying for that? And is that cheap, right? Is that cheap enough to bring you back into stocks, right? We've talked a lot about that level over the past couple of months, where I'm looking at stocks and what levels on the S&P 500 and in the stock market that I'm buying, and what gives me confidence, right? Because the idea here, folks, is not to pick the bottom of the stock market, but to hold some money aside to be able to invest at a point where you're confident that even if the stock market falls further, then you're not worried, okay? Because you know that at that point, you got a cheap enough price on stocks, a good enough deal on stocks, that even if the stock market falls further, then eventually it's going to rebound, and that price that you got is going to be a great deal, and it's going to be great returns into the future, okay? That's what you're really looking for. That's what you want to look for in these, in these levels of where you're investing and where you want the market to get before you really get excited about buying stocks. It's not about picking the bottom of the market or saying, for sure, certainly that the stock market crash is over, that the bull market is now begun. It's about waiting until you get that price to be confident that, hey, whatever happens, I'm happy with this price that I got in the market. For that, we're going to go back to this the FactSet Earnings Insight, right? We're going to look at the price to earnings ratio on the market right now, some earnings expectations for next year, and what levels would make us confident that we are getting that best price. Okay, so again, this is a FactSet Earnings Insight. Okay, one of my favorite tools there on the for research on the internet. All you know that it's you go to Google, you type in FactSet, right? That's FactSet Earnings Insight. It's totally free to get this report. It's a weekly report they update each week on market earnings expectations, analyst expectations, things like that. And what we're looking at here is the trailing 12-month PE ratio, so that price to earnings ratio for the market itself. Okay, the price of the market, so the price of the S&P 500, right around 39.92 right now, divided by the earnings of all the companies in that market. Okay, the top 500 companies in the United States. The price to earnings ratio, so for the valuation of that. What we see here is in the dark blue here is the current price to earnings ratio. In the blue dash line here is going to be the the 10-year average, and green here is the 5-year average. So obviously, with stocks very much overvalued over the last 5 years, that green, that 5-year average is going to be much higher. That's not what you want to look at, because I think, stocks have been overvalued on average over the last 5 years. Even this dashed blue line, we're just over 20. So for the last 10 years, the average PE ratio on stocks in the S&P 500 has been just over 20 times price to earnings, right? I think that's a little bit much too. If you actually go out further, I mean, if we could go out to 20, 30, 40 years here, then you would see that average price to earnings ratio was closer to around 18, right? 17, 18, 19, somewhere around there for that long-term average. Why it's been so high over the last 10 years is mostly because of interest rates, right? Interest rates have been so low for the last 10 years, historically low, that there was really no alternative but stocks to invest in stocks. And so those low interest rates really pushed up the valuations on stocks past that 17, 18, 19 times price to earnings ratio. Now, as interest rates do start to come up and look like they're going to stay up higher for longer, then you might want to hold out for a little bit lower price to earnings before you really get excited about investing in stocks. But that's neither here nor there. I'm not going to give you an economics lesson here. We just want to look at what we're looking at right now. And what we see right now is with the earnings in the S&P 500. So I'll bring up our trusty little calculator here. With the earnings of the S&P 500 right around $225 for this year. Okay, so expectations, we've still got that fourth quarter to report, but analysts are expecting about $225 in earnings for S&P 500 companies to report this year. With the market at 39.92 divided by that 225, we get a price to earnings ratio of about 17.7, right? Almost 18 times. Okay, and so that's where we see it. Right here, it would be here. It's a little bit over. It's about 18 and a half or so, just because we don't have those fourth quarter earnings in yet. But it would be just almost 18 times price to earnings. So you look here and you look here, and that's quite a bit down from the 35 we hit last year. That bull market peak in January of this year, and in December there, stocks were trading at 35 times on a price to earnings ratio. We are well below that, so we are not expensive here, but we're not necessarily cheap either. The pandemic crash in 2020 brought stocks down to less than 15 times. Even 2018, when we had that little mini crash there in November, December of 2018, stocks came down to 16 times. And you can see, if we went back historically, you'd see that it was right around 15, maybe 16 at the most, but I'd say really 15 times on a price to earnings ratio is really a great time to be buying stocks. Okay, that is that time when, that point where you can be confident that if you buy stocks at 15 times on a price to earnings ratio for the market, that's we're not talking about individual stocks here. That's going to be depending on where the historical PE ratio for each individual stock, where that should be, things like that. But we're just talking about kind of getting an idea of where the market is at, how expensive the market is, and that's going to affect all the other stock prices as well. But historically, if you were in at 15, even maybe a little bit higher, 15 and a half, 15, 16 times on that price to earnings ratio, you could be confident that, yes, even if the stock market fell further, and a lot of times it has fallen down to 14 to 12 times on a price to earnings ratio. But if you got in at 15 times, with your cash, that was going to be a pretty good level, okay? Because eventually, stocks would rebound up to 20 times, up to 24 times, even 35 times price to earnings ratio. So that is a lot of gain on those stocks that you bought at 15 times. So what we can do is, we can use that number and kind of get an idea. Okay, stocks are right now at about 18 times, so not necessarily cheap. We can look at what the market is expecting for earnings next year, here we look at the S&P 500 bottom-up EPS estimates, right? So what this is right here, this is the analysts that are polled by FactSet. They give their earnings estimates for all the companies in the S&P 500, right? They're saying, okay, we've added up all the earnings for these 500 companies in the stock market index, and this is what we think on total they're going to be, right? So here again we have that $221 for this year. I think it's going to be closer to about $225 for the year, but either way, and now analysts are expecting earnings growth for next year. Okay, they're expecting $232 per share for S&P 500 companies in 2023. So that would be 232 divided by 221 is what they're expecting for this year. That would be about 5% earnings growth next year. Now the problem is, and what I've been talking about for the last few months, and why I think the bear market isn't necessarily over, why the bull market isn't necessarily begun yet, is because these earnings estimates for next year are just ridiculously high. Okay, how do you get a recession and still get corporate earnings up 5% in the year? It just doesn't happen. We've seen the research by Deloitte. We've seen other research that shows that corporate earnings typically fall between 10 and 20%, when we get a recession. And frankly, folks, honestly, there is no way we're avoiding a recession. Okay, you cannot raise interest rates by 5% from 0 to almost 5%, 4% in 1 year and not expect it to bring the economy crashing down. Okay, Europe is already almost in a recession because of gas prices there, because of natural gas. China is with their zero COVID lockdown policy. They are, dangerously close to a recession. The United States is going to be very quick to follow, and we are going to have a recession here in 2023, if not in the fourth quarter. So to say that companies in the S&P 500 are going to report $232 in earnings, 5% growth next year is just ridiculous. It's just a blue sky scenario that analysts haven't come down from yet. They have started to reduce those expectations. Analysts were saying at the beginning of the year, they were saying that the market was going to do $250 in earnings next year. The $250, that's come down to $232, but that still needs to come down further. Okay, I think when all is said and done, it's going to come down to at least 220 at the best. So basically flat earnings growth for next year, probably down a little bit more, probably down closer to about 210. Okay, that would be a recession. That would be earnings decline, because we do see that, when this only goes out 10 years. But we see that when we do have a recession, those earnings decline. It's just the nature of a recession, right? Corporations make less money because the economy is falling, the economy is receding. So yes, I do think that this number 232 is going to come down to probably about 210. And if we do that same price to earnings math, that simple math, price to earnings, if we look at 39.92, that's where the S&P 500 is right now, divided by, we'll say, even optimistically, $220 per share earnings for the S&P 500 companies next year. That puts us at 18 times on a price to earnings basis. If we go even further, if we go 39.92 divided by 210, where I think earnings are going to be next year, that's at 19 times. So if we use these numbers and we look at where that PE ratio has been historically, 19 times. That's the forward one. We want to come down here to the trailing earnings. 18, 19 times, that is not necessarily cheap. That is not the point where I would be confident to say that, even if the market falls further, I'm getting a good deal. Okay, 18, 19 times earnings is not a good deal for investors. I want to wait till that comes down to at least 16 times on a price to earnings ratio, right? Which is why that we've been talking about those levels. I've been targeting closer to 16. Okay, so 16 times on a price to earnings ratio times those $210 in earnings next year, that would be closer to about 3,400. That'd be 3,360. That's currently right around where Morgan Stanley, Mike Wilson, his target is about 3,300 on the S&P 500. That'd be about 3,360. If we go 15 times, which would be really what we want to see to be confident that we're getting a great deal, that would be 15 times that $210 in earnings, that would be 3,150. Okay, so again, those levels, 3,150, 3,360, right around there, that is where I'm confident that I am getting such a great deal on stocks, on that price to earnings ratio, that just basic measure of stocks. What are you paying for the earnings that you get out of those companies? That basic valuation that is, the most basic, the most fundamental thing about stocks. At what point are you confident that you're getting such a great deal that you don't care if the market falls further or not? It's not causing you stress because you know you got a great deal. And we are not there yet. Okay, with this huge rebound last week, with this bear market rally that we've been getting over the last week, stocks are still pretty expensive. So, of course, this all begs the question of what do you do now? Okay, if you do believe that the bear market isn't necessarily over, that we are heading for lower prices, maybe not necessarily lower lows, down below 3,500. So what do you do? I will admit we are no doubt coming to the end of this bear market. With the Fed is going to be slowing down its rate hikes. That is going to be good news for the stocks and for the economy eventually. But we are seeing a slowing economy. We are going to see a recession. Stocks are not cheap. Stocks are cheaper than they were last year, but it's not a slam dunk, right? It's not that point where I'm confident that I can invest. Momentum from last week could carry us through to 4,100, maybe even 4,200 at the most over the next couple of weeks. But then it's going to fall apart. We're going to get a weaker than expected or a higher than expected inflation number. We're going to get a higher than expected jobs number, something like that is going to bring back those fears in the market. Investors are going to realize that stocks aren't cheap. Analysts are going to start downgrading their expectations for earnings, and that's going to bring the stock market back down. Stocks could easily fall another 7-10% down to that 3,700 level on the index, right? So we've yet to see the full effect of those rising interest rates. That's gonna cause the economy to fall further. And I don't say this to be a negative Nancy, right? I don't want to be pessimistic all the time about this or to piss on your parade, but I just want to be a voice of reason, right? And smart planning, okay? And I can show you what I'm doing in my portfolio. I am down from, just a few months ago, I was talking about how I was 25-30% in cash, right? 30% of my portfolio was sitting there in cash, waiting for those lower lows. I did jump into the market when it hit that 3,500, that 3,500 low there in mid-October. So I put a lot of that cash to work. I've been putting a lot of it to work, in some of those really crashing tech stocks, the social media stocks and Amazon, things like that. So I'm now down to about 14% of my portfolio in cash. So that is quite a big change, right, from where I was. But I'm still holding that 14%, right? I'm still holding 10, 14% at least, to take advantage of what could be probably a December or January sell-off, right? A retrenchment, really even maybe even lower lows below 3,500 back down to those targets of 3340 or 3360 down to 3150, right around there. So I am still holding some of that cash back just in case, okay? And what we want to do here and what I'm doing is, again, that barbell strategy. I'm investing very heavily in those growth stocks that, are changing the world in which we live, those growth stocks that are still growth companies, even if they're not making everybody rich every day, right? Everybody loved the growth stocks, Amazon, the FANGs, Facebook, Apple, Netflix, Google, the Teladocs, the SoFis. Everybody loved them when they were making everyone rich, right? When you thought you were going to retire in 5 years because these growth stocks were doubling and tripling every year. That's gone away, but they are still growth companies. Okay, these are still companies that are leading their industry, leading growth industries, and are still going to be doing 15, 20, even higher, 25, 30% revenue growth. When the economy does rebound and starts picking up. Okay, so that's where I want to be with part of my money in that barbell strategy, right? Because those are the stocks that are going to rebound the fastest when the bull market does start. Okay. And even as we get these bear market rallies, those are the stocks that are rebounding faster. My portfolio, even with this Bitcoin loss, even with this cryptocurrency loss, my portfolio was still up $150,000 over the last, over those 2 days, Thursday and Friday, because I do have that exposure, that focus on growth stocks in part of the portfolio. Now, with that barbell strategy, though, that means you do have that focus on one end, but you also have a focus on the other end. You also have that cash set aside, the cash, the safety stocks and utilities, consumer staples, things like that. to give you the opportunity that if the market does come down further, then you can use that to buy more into those growth stocks and buy into some of those lower valuations on other stocks, right? It does kind of suck for dividend and value investors because there's no room in the middle. If you look at a barbell, there's really no room in the middle other than just to grab a hold. Okay, you've got the growth stocks on the one end, you've got the safety stocks and the cash on the other end to protect you, but there's really no room for the middle, because what happens if you try to diversify across all those dividend stocks, those value stocks, those are really going nowhere. Okay, those aren't going to rebound nearly as much if the stock market does increase, and they're still gonna fall if the stock market does fall further. Okay, so it's really kind of the worst of both worlds. With this, you get the best of both worlds. You get the high growth with those growth stocks, you get the protection from that cash and safety stocks and things like that. And that's really, I think, where you want to be, in this kind of uncertainty around the stock market. So that's what I'm doing. That's what I'll continue to do probably through December, January. I do think we're probably going to see, if we do see lower lows or even another crash, we're going to see that by January of this year. By that time, you start getting closer to that federal that end to the Federal Reserve rate hikes there in February. You start seeing a little bit more of what the economy is going to do because of these rate hikes. So I think you start seeing a lot better prices there end of December into January, and I think that's at the point where you do start to say, okay, you know what, the bear market has run 12 plus months. It is much longer than average. This is where I want to start being a little bit more aggressive with what I'm doing in the stocks. So that's where we're at right now. I do want to turn it over to our stock market update to give you a look at what I'm looking at for stocks this week. Got to find where I'm at in my. Oh, here we are. Okay, stocks to watch this week. The stocks I'm watching, earnings are pretty well over, but we've got a big week for the for the retailers. Okay, retailers are really going to be the ones reporting their earnings this week. It's going to be closely watched on the health of the consumer. Okay, remember the U.S. economy is 70% driven by consumer. Okay. 70% consumer driven, consumer spending. The National Retail Federation has forecast that November, December retail sales, so those key holiday retail sales are going to be up 6 to 8% over the last year. That would be about half the 13.5% pace of the last year. So it would still be down quite a bit, but still really welcome growth by investors, right, and retailers that are looking at the possibility of a recession and slower consumer spending. So again, expected about 6 to 8% retail sales over these next 2 months. It would be down, but it would be strong. But I'm thinking retailers this week, the big news this week is going to be the retailers like Walmart, like Target, like Lowe's and Home Depot, like TJX coming out with their earnings for the third quarter and really probably throwing cold water on that idea, on those expectations. What I'm looking at with the biggest picture, the big thing that you're going to be hearing about this week. So listen and remember I said this. The big thing you're going to hear about this week is unsold inventory. Okay, that has been its highest it's been in decades. Okay, companies, retailers like Walmart, like Target are sitting on so much unsold inventory, so much products and goods that they haven't sold. They thought they were going to be able to sell, but they haven't. They're sitting on so much of that they are now going to start talking about discounting, big discounts for the holiday season. Okay, because of that, they don't have warehouses. They don't have a lot of warehouse space that they can just store this inventory in, and they want to get rid of it, right? Move it out of the way for whatever comes next. So they're going to have to discount this even more than we usually see during the holiday season, even more than we usually see for Black Friday or for Christmas shopping. It's good news for consumers, but what is it going to do to those retailers' earnings? Okay, you're going to see, what we've seen this year so far, what has saved a lot of those companies, those retailers, is that they've been able to report surprisingly strong revenue growth, right? Sales growth is 7, 8, 10% higher because they've been increasing prices, right? Inflation has caused those prices to increase. Retailers have increased their prices. Consumers are paying it. So they have been very good sales growth. The problem is they haven't been passing on all that inflation to consumers. So the wage inflation, the supplies inflation that companies have had to eat, that has meant lower earnings. Okay, so we've seen high sales growth, low earnings growth, maybe even negative earnings growth for a lot of these companies over this year. Well, what's going to happen in this last quarter when companies are trying to sell all that unsold inventory and are going to have to now lower their prices instead of increasing them? Now we're going to see even bigger earnings drops. Okay, now we're going to see a very disappointing earnings season for the fourth quarter for companies. Companies are going to want to get ahead of that. They're going to want to warn investors, say, hey, you know what? These earnings expectations for our fourth quarter are way too high, and we want to throw cold water on that idea. We want to manage those expectations. We want to bring those down, so it's not so much of a surprise when we start reporting those numbers here in January and February. Okay, so I do think a lot of these retailers this week, you're going to hear a lot of bad news. You're going to hear a lot of warnings, and that could jeopardize the stock market rally. Okay, we don't know quite how bad it will be yet, but I think you're going to hear a lot of that. You know, from the first one from Walmart here. Walmart's going to report its earnings on Tuesday after easily beating its expectations last quarter. Shares of Walmart were up 6% in August on that second quarter report. This quarter is going to be a little bit more difficult, right? This quarter is going to be, earnings are expected at $1.32 a share. That's 9% down from last year. Revenue is expected 5% up to $150 billion, $148 billion. Again, that's what I'm talking about here. Retailers so far this year have been able to raise their prices to cover some of that inflation, but haven't been able to cover all of it. So they're seeing a 5% increase in revenue, but a 9% drop in earnings, right? All those other costs that are coming out. That's a pretty unreasonably wide spread right now. So I have no doubt the company will be able to beat those earnings expectations. Sales growth probably 5-6%, maybe even a little bit higher. Earnings probably flat over the last year, so higher than $1.32 expected. But it's what they're going to say about earnings over the next quarter. The earnings surprise probably won't be as high as or as much as a surprise as it was last quarter, and that outlook just isn't going to be as rosy. Okay, Walmart warned on its inventory levels last quarter. Again, they said that those inventories are building up. They're going to have to discount some of that. They've already tried to make a public show of discounting some Thanksgiving items down to last year's prices, right? So Walmart is out saying, hey, we're the good guys here. We know prices are higher than last year, so we're going to take a lot of these Thanksgiving Day items and we're going to sell them at the same price we did last year, just because we're such great people, right? Walmart looking after your pocketbook, which is great, but I don't think it's necessarily all the truth there. Of course, what we're seeing is that they just have so much Thanksgiving Day crap that they've got an inventory that they can't sell, that they're having to discount it, right? And that's what we're going to see through this quarter, through the holiday. We're going to see steep discounts by companies just trying to get rid of all this shit that they've bought and they can't sell. Okay, so it's sales growth is expected 4% for the fourth quarter. I think they're gonna come down on that. They're gonna say that our sales for the fourth quarter might not even be that rosy. Might even be down a little bit. Our earnings are going to be down much further, and that's going to be something you're going to hear from all these retailers this week. And again, it could be the thing that stops the stock market rally. Okay, just that idea that they're going to have to do some deep discounting. NVIDIA Corporation. NVIDIA is going to have a lot of eyes on it this week. It's up 45% in the last month. Okay, it's down today with the rest of the market. Up 45% over the last month, though, just on that stock market rally. The problem with NVIDIA, though, here is just the outlook. Again, the outlook that this company is going to have to give. Okay, earnings are expected about 40% lower to 70 cents a share versus the third quarter last year. 18% hit to sales over the period. So sales are expected 18% lower than last year's same period. And a lot of this, and what I'm looking at is for NVIDIA, why I think this could be even worse than expected, is a lot of this is a dual slowdown in chip demand for gaming PCs and crypto mining data centers. Okay, obviously, so gaming PCs, even PC demand in general has been falling all year. Okay, everybody rushed out during the pandemic to buy new PCs because they were going to be working from home and stuff like that. And so chip demand just exploded. NVIDIA had a great couple of years. Well, that's starting to come down. down. Cheap asses like me don't buy a computer more than maybe every 3 to 5 years. Okay, so you're not going to get good strong PC demand for another year or two at least. Gaming PCs also, people loved to game during the pandemic when they were locked down, had nothing better to do, so they were playing all these games like Fortnite and Minecraft and shit like that. So they're not doing that anymore, right? So the chip demand has fallen. Crypto mining obviously has just fallen off a cliff. Okay, a lot of these crypto miners are now in bad situations where they're actually selling their mining equipment, getting out of the business altogether. So that chip demand for crypto mining and the data centers falling off a cliff as well. Both of those trends just got worse in the third quarter. Will probably get worse in the fourth quarter as well. We've yet to see kind of the restrictions on selling chips and the AI technology to China, how that's going to affect the industry. But I really do think Nvidia is going to come out and disappoint the market when it reports on Wednesday saying, hey, we have no certainty over where this is going to come out with PC, with gaming sales, with chip demand as far as cryptocurrency, things like that. So it could be ultimately a very disappointing quarter for Nvidia. Alibaba going to report its earnings on Thursday. Shares are up 11% from the October low, and China stocks are up just broadly last week on news that the government might finally be kind of easing up on some of those COVID restrictions, start to easing that. Internet retailer Alibaba is expected to report 3.6% earnings growth to 11.61 per share, 4% sales growth over that period. More important, though, of course, as always, is just what management is going to say about the current quarter, about fourth quarter, and their merchandise volume around the Singles Day event. Okay, so China Singles Day, the biggest shopping day of the year, online shopping day, that happened last week. It was really worrisome because, they didn't have a lot of their big name live streamers that were selling stuff. Obviously with the restrictions, with the economic slowdown in China, everyone was worried about, how that Singles Day is going to look. They did kind of report that, rival JD.com in June reported its slowest ever sales growth for its 618 day event, right? Which is the 618 day. Don't ask me. I don't know where they get these names for these days, but 618 day is the second largest shopping day after Singles Day. They reported their slowest ever sales growth for that day. So everyone's worried. Alibaba did come out over the weekend and say that their merchandise volume for last week's Singles Day was about on par with last year, so zero growth there. Maybe a little bit higher sales growth just on higher prices. But, everybody's a little bit worried about what Alibaba is going to say about that on Thursday. Now, the reason why I own shares of Alibaba, it's the only Chinese stock that I hold or would hold right now, is just because of that valuation, right? Alibaba trades for just 1.5 times sales. That's compared to 2.0 times sales for Amazon, which is also very cheap. I also own Amazon, very cheap on a historical basis. These e-commerce sites, these e-commerce leaders, right? The two largest e-commerce companies in the world. I think what we're talking about here really for me is, again, that confidence in thinking that, hey, the valuation is so low here. I don't care if the stock comes down even further on bad news. I know at this point I'm getting a good deal on those shares, right? So, current outlook quarter could be a little dicey, but we do have the fact that China is easing some of those lockdown restrictions. News that American auditors have finished their audit of some of those companies, those accounting companies in China. We could see some of that uncertainty come off from the fact that these Chinese stocks won't be delisted from the U.S. market. Want to look at what the sectors did last week, and then we'll hit into your questions. Love answering your questions there. Looking forward to that. I haven't done these live streams here in a few weeks. I don't know if I had COVID or just a really bad cough, but I was down on my back for about a week there. But here we are in the sectorspider.com sector tracker. Looking at last week, all 11 stock sectors did close higher last week, so that was part of the good news we got from that rebound. Obviously, the hardest hit sectors were the ones that started the largest bounce, right? Tech stocks jumped double digits, 10% over the last week. Communication services stocks, so all those internet names and the social media stocks jumped 9.4%. Here, you see that here. And of course, the laggards were those safety sectors that saw investors rushing out to invest in those hot stocks, right? So consumer staples was up only 2.3%. Utilities up only 1.5% over the last week. And of course, yes, it's just because investors got enthusiastic. They say, hey, the bull market is here. We want to be back in these risky stocks. We want to be back in shares of internet stocks, in communication services. We want to be back in technology. The bounce was welcome, and don't get me wrong. Like I said, my portfolio did welcome that bounce, but it really didn't make much of a difference in these year-to-date numbers, did it? Okay, we look back at the year-to-date here. Energy, the only sector posting positive gains at 67%. Really amazing returns for the energy sector. Every other sector is still in the red here. And, momentum, investor enthusiasm, like we talked about, could take some of these lagging sectors higher over the next week. But investors really do need to think about protecting this from this bear market rally, protecting some of their stuff, and really focusing on that cash and that barbell strategy. Okay, I do want to get to questions now. I'm gonna scroll up here to see questions people are asking. If I don't see your question, make sure you can go ahead and ask it again. Make sure you use a question mark so I can see what that it is a question. I'm going to scroll up through here and see what we've got. Again, great seeing everybody after a few weeks of not doing these live streams. Great seeing everybody there. Melanie, Ambrose, good to see you there. Grunchick from Switzerland, how are you? From Romania, Bulgaria. Awesome to see everyone there. Yes, Ambassador Ambrose, some of those long-term members of the Bowtie Nation. Joseph Flores there from Dallas, Texas. What do you think about high dividend marine bulk? Okay, so Michael wants to know about some of the high dividend yield stocks in the bulk carriers, right? So stocks like SBLK, GOGL, a lot of those stocks post high double digit earnings. We've got the lawn cutters outside, so invest in lawn equipment, I guess. But no, a lot of these bulk carriers. Now, what I'm looking at with the bulk carriers, anytime you look at those high dividend yields, folks, right, 15%, 20% dividend yields, those are not sustainable. Okay, a lot of times those are going to be cut. If you look at the dividend history for a lot of those companies, and one thing I do want you to look at whenever you look at the dividend history of a company. So we'll just look at one of your stocks you mentioned here, SBLK, Star Bulk Carriers Corporation. Okay, and we don't see the actual dividend yield here because some genius over there at Yahoo Finance changed the layout here to not show dividend yields, which is probably the dumbest thing I've seen in the history of investing. Because most investors are going to want to see that dividend yield. They don't show it on the main page here. So somebody call Yahoo Finance and tell them, you freaking morons, put the dividend yield back on the main page. Now we have to go to this statistics page to find the dividend yield. Dividend yield for Star Bulk Carriers now is, what do we got here? Dividends right here. We've got payout ratio, or no, that's payout ratio. Dividend yield of 31%. So, I can see where a lot of people would be kind of excited about a 31% dividend yield for this stock. But what you got to do, you got to look at two things. You got to look at, one, the chart on it. Are they destroying stock shareholder value? Been pretty good as far as the price over the last couple of years. It has started to come down here in May, and it's down quite a bit. But everyone's down in May, so no big deal there. What you also want to look at though is go to this historical data and look at that dividend. Okay, so you can go down 5 years here. You can go to dividends only and click apply, and this is going to show you the dividends over that period. Okay, so we see Star Bulk Carriers has only been paying a dividend since 2009. Okay, they have increased the dividend payment from 5 cents all the way up to $1.65. But that is not a lot of years for dividends on this. And what we've seen is really just over the last few years. I mean, these carriers have been doing great, with the supply chain problems. The carriers, the undersupply of carriers out there on the market has just been huge cash flows for a lot of these. This Golden Ocean Group, Star Bulk Carriers, Eagle Bulk Shipping, a lot of these have become just dividend machines. But you got to kind of wonder, right? These dividends are not sustainable. His company does not have a history of dividends that gives me confidence that they're going to be able to keep this dividend and are going to keep paying out. So, you can invest some of your money in these high dividend stocks. That's not a problem. I would go through, look at the companies that are have maybe a little bit lower payout ratio. So look at the price, look at the earnings, look at how much they're paying in those dividends to give it a little bit more dividend certainty, right? A little bit more dividend sustainability. But the problem is we're seeing is a lot of these industries, you look at these carrier industries, these bulk carrier industries, and you really got to follow, if you're going to put a lot of money into these stocks, you got to follow the supply and demand of those ships. Okay, so what we saw obviously the last few years is they just haven't had enough ships. So those prices, for the rates for those carriers really went up, and that's been that cash flow. Okay, now what we're seeing is they saw that and they said, hey, we're calling the shipbuilders. We need more ships, and we're starting to see those new ships come online. Okay, I've seen estimates over the last week of 20-30% increase in carrier capacity over the next couple of years. Okay, so what do you think that's going to do to those bulk carrier rates? That is going to bring them crashing down. Okay, and so the problem is, what I fear for these carrier stocks is that those bulk carrier rates are going to come down so fast and so hard that first they're going to cut their dividends, and then you're going to see some bankruptcies in some of these companies, right? Or you're going to see moves to protect their cash flow, right? So again, you can take advantage of some of these high dividend yields, these good dividends for some of these stocks. Don't go overboard though. Again, remember, we always say keep your exposure to any one stock down to 5% or less. Definitely no more than 10%. You never want to have more than 10% of your money in any single stock, and that's just going to protect you if something happens to that stock. Bad things happen to good companies, folks. Remember that. You can have a great company in the world, but something happens to it. Management does some kind of crap with it, and you can see your money disappear. So you never want to have more than 5% of your money in any single individual stock. Now, that doesn't mean put all of your money in 5 or 10 different bulk carrier stocks. You also don't want all of your money in one single industry or sector. Okay, so you do want to diversify it out a little bit, but there's no problem with some of these a little bit more. Okay, what else? Is it worth putting eggs in defensive stocks, or runway has already ended? So let's see, BI Wise Consulting wants to know, is it worth putting some eggs in defensive stocks, or has that runway already ended? Okay, so that's really what we talked about with our main topic. Is the bull market here? Is the bear market over? Will we see higher prices? Things like that. And again, I am not convinced that the bear market is over. Stocks are no longer cheap. They got pretty close right now on 3,500 in October. I put a lot of my cash to work. But I still think you still need some of that protection, right? So again, talking about that barbell strategy, you can have some of those tech stocks, some of those growth stocks that are going to really make you that money over the next 10 years, but you still want that other side of the barbell. You still want some cash. You still want maybe some of these defensive stocks. If you want healthcare, consumer staples, utilities, stocks in those sectors that are going to protect you if the market does come back down again. So I would take advantage of some of that. What else? Kenny wants to know, what about your thoughts on Invitae's Q3 results? Invitae, so ticker NVTA, has been surprising us lately. It's one of those biotech stocks. It's a genetics testing stock that I've held for a little while. Started buying it this year when those growth stocks started coming down. It is up. We can look here in the last month. It is up, almost is more than 50% here in the last month. It's something we talked about in our market update last week. It was around 240. I did say, hey, look at that last earnings report. Look at the earnings report before this last one last week, and they are consistently surprising the market at their sales and their earnings, right? And so, I'm not saying the bad news is over for this stock. If we go further out and we do look at that last earnings report, it was up. Here was 230. It jumped up to 860. So it was up like 400% in that day on the earnings. But then it fell back down, and oh no, we suck again. That kind of thing, right? So I'm not saying that it can't come back down to 240, 250 a share. But over the long term, I do like the fact that the company is able to surprise investors, and that's really what we're looking at here with these growth stocks. You look at these growth stocks, and when the ones where management is able to come in and say, hey, our business is still growing. We are still a growth company. Invitae is still a growth company. They are still, doing very well on sales, getting to that earnings profitability, and eventually, as this company grows, as the market recovers, this is going to be a very strong stock, right? So that is why I'm holding on, even if we come down from this $3.40 a share, down 5% today, as if the market does continue to, or if the market does fall further into, December, January, like I think it will, this stock is going to come back down. It's going to come back down to about $3 or even under $3 a share. But over the long term, this is still a strong company, a strong growth company. And I really do appreciate that management is able to, to grow it like that. And I just realized I wasn't showing you the graph on that. So turn it over here. You can see over the last month here, it was, 220, 240. Over the last week, it jumped again on that earnings announcement that they had last week, up to $3.70 a share. So up over 50%, well over 50%. If you look out here, you see that that August earnings update that it had, that it was up, 400% plus. Great earnings announcement. It came down since then. But again, what I'm talking about here is a company, a growth stock that is still able to prove that it's a growth company. The management's still able to grow this company. That genetics testing industry is a growth industry, and they're able to lead it, in that industry. So that's what I'm looking for in these growth stocks and in that growth company. So I like Invitae. I hold shares, and I'm giving it time to rebound and to grow into that thesis. Okay, so Danielle wants to know, rotate out of oil energy stocks, earnings 2 years out from now. So yeah, 2 years out from now, energy might not look as good as it does. What I'm thinking right now is that energy companies, oil stocks, they are still cash flow machines. Okay, even with oil coming down, even if it comes down to $75, $80 a barrel, I think a lot of these companies, they have cost of production right around 30, 40, even, as high as $45 a barrel, right? You take companies like CVX, companies like, ConocoPhillips, which has 50%, about half of its, production in the cheaper Permian Basin down there in, around Texas. They have about half of their production over the next 10 years in that cheaper area to produce. So their cost of production is going to be, right around $35, $40 a barrel. So even if oil comes down a little bit from where it is now, then I think they're still going to be cash flow machines, right? Another thing that we've talked about over the last couple of weeks, about 2 weeks ago, had the market update focused on oil stocks, right, and the oil production. And what we see here is the U.S. has been withdrawing oil from its strategic petroleum reserve, that SPR, for all year, right, trying to bring those oil prices down. It's had limited effect, right? But we have withdrawn, so much oil from the SPR. It is now down to like a 30-year low. We are down to about 400 million barrels in that SPR of oil. That is dangerously low. It might seem like a lot, but it is down dangerously low. Of that, we have very much less of the light sour crude that is the best for refining into gasoline. So we are getting down to the U.S. still wants to withdraw some more barrels from that reserve. We are getting down to a point where we can't take any more out of that reserve. And where it's not going to protect us much if we do get increases, any geopolitical events that drive up the price of oil, right? So we've been taking out about 1 million barrels a day out of that reserve area, out of this SPR. And what I'm thinking is, what happens when we're refilling that SPR, okay? Right now, we've been pushing 1 million barrels of oil a day onto the market. That is higher supply. That is, keeping those prices down for oil. What happens when we're not only not pushing that 1 million barrels a day onto the market, but we're taking 1 million barrels off to refill the SPR? That is a 2 million barrel a day change in the in the supply demand picture for the market, for the world oil market. Okay, that is going to have the effect of supporting those prices in oil and oil stocks. Okay, so I'm looking at, even if we do get a recession, Oil prices could come down a little bit, could come down into that $75, $80 handle for oil prices, but we're going to have that floor of support because of what we're going to be doing with that petroleum reserve and refilling that over this next year. So, I do like energy stocks at least over the next 6 months, especially, as kind of a hedge against the rest of the market, against the weakness in the rest of the market. So I do like oil stocks at least into the next 6 months, probably out in maybe even longer term out in the next year. Again, eventually you do have to start thinking, okay, you know what? Oil demand is going to start falling as we do get more electric vehicles on the road, as we do get more, alternative energy sources. But that is, at least 2 years out, I would say. So I think, just because we haven't produced enough and we haven't spent enough on production, another thing we talked about in that live stream or in that market update a couple of weeks ago is that the oil companies in the U.S., they just aren't spending on their production. Okay, ConocoPhillips, one of the stocks that I'm adding to the Bowtie Index, they have made a commitment to only spend $8 billion a year on new production and new fields and new exploration, things like that. That is only enough to marginally increase their production each year, right? And a lot of oil companies are like that. Despite higher oil prices, they're looking further out and they're saying, hey, we're not going to spend to develop those oil fields now that might produce oil in 5 years if that demand in 5 years isn't going to be there, right? They've been doing that since 2014, cutting that spending, and it's really coming through in very much lower oil production. And of course, just basic supply demand function of the economy. You've got lower supply, the demand is increasing, and you're going to have higher prices, right? So that is why, I think oil prices are going to stay at least up at the $75, $80 handle and even higher over this next year, and is going to make these oil stocks cash flow machines. Okay, what else? Troy says, colder up here. First traces of snow on the ground. We're still doing pretty well here in Florida, other than the constant hurricanes. But yeah, you've got that. You've got the colder weather coming through in the north as well as in Europe, and I think that's gonna mean a lot of things for energy prices, for consumer spending, and things like that. What else do we have here? Drop. What's a good deal on Google? So Blue wants to know what's a good deal on Google. Actually, I like Google. I haven't picked up shares yet, but I think it's probably one of those on my list. We can look at the stock chart here. I mean, Google. What I like about Google is you're at this price. You're probably getting basically the core search. You're getting the YouTube earnings off of that price, off that $100 a share. But what you're not seeing in this price is all the money. And again, we love the weed whackers out here. What we're not seeing in this price is all the other alternative investments Google has, right? That Waymo self-driving unit, all the AI technology, all the healthcare technology they're investing in. So I think you get kind of a lottery ticket buy here with Google. That's Alphabet, ticker GOOG. I think you can buy at this price. I would wait for a little bit longer. We can see the price to sales ratio here. So right now, Google is trading for about 4.5 times on a price to sales ratio, and we can look at Morningstar to see what that has been historically. Obviously, I can tell you it's been a lot higher historically. So it is it's a decent deal now, but we want to know if it's a really good deal. Okay, so we can go here to valuation, and that's going to show us the history for this for this stock. I'll increase this a little bit so you can see it here. Okay, so if we look at history for price to sales on Google, it's 5-year average has been about 6.5. Right here, you can see the current average current price to sales ratio is 4.5 times. 5-year average 6.5. Now that's 5-year average is too high, right? 6.5 times on a 5-year basis. It's when stocks were expensive. But I mean, even if you go further out here, you got 7 times in 2017. You've got you've got 3 times, 2.6 times in 2014. So that was kind of the low for valuation. But 5.6 times for 2018. Valuations came down quite a bit in 2018, but that was still 5.6 times. So 4.5 times on a price to sales basis for Google is really good. Is really attractive here. Obviously, I wouldn't jump all in with all my money because I do think the market weakness is going to bring this stock down a little bit further, but I don't think you see much further down from here. $96 a share for Google. I think it's a good area to get in. What else? What's a good deal? Timing the market. Love the economy lessons. What else? 2 options on Google. Just scrolling through the questions, trying to find questions here. Any updates on thoughts on Groupon and Salesforce? Are you buying, holding, or selling? Okay, great question by Vipul. Got 2 stocks here, Groupon and Salesforce. So first, Groupon. Groupon is just a cluster. I don't know what management is doing there, but basically Groupon's valuation is now down to the point where it's only valued at their investment in SumUp, right? So if you don't know, Groupon, the online retailer couponer, actually has a 2.5% stake in the British payments processor SumUp, right? It's a payment processor. It was at one point it was like a $20 billion valuation, which, if we do 2.4 times 0.024 times 20 billion. That alone is $480 million value. Okay, just that investment in SumUp. Well, obviously, private companies' valuations are a little iffy. You never really know how much they're worth until they go public or get sold to another company. That valuation has come down quite a bit. I think the last funding round was actually about $9 billion. But even that, so if we take a 2.4% stake, which is the stake that Groupon has in this British, online payments processor, right? 2.4 times, we'll say, $9 billion valuation. That alone is $216 million. Okay. And if we look at, let me bring up Groupon for you here. So if we look at Groupon right now, it's down today. It was up big time last week, but a market cap of $292 million, right? So market is saying Groupon is only worth $292 million. That is basically this investment in SumUp. So the market is saying that, Groupon isn't worth anything. They're saying that core business of online coupons, is not worth anything. And in fact, if you do look at, the value or the financials for Groupon, they are losing cash. They're burning through cash because they're losing money. So that core coupon business probably isn't worth much, but they do have that SumUp valuation. That is why I'm holding the shares, because I think they, eventually they can find a way to monetize that SumUp investment, whether they have to sell it to someone else, whether SumUp eventually gets, some kind of acquisition offer or an IPO, and they monetize that SumUp, right? That's going to give them a lot of cash. And, the coupon part of the business, it is worth something. Okay. Just this year, Groupon signed on a partnership with Amazon to be able to host their deals through Amazon. We don't know quite how that's working out yet, but that's worth something. Groupon still has a large market share of that online coupon market. So that is worth something. Okay. So I'm holding out to see, how they monetize that SumUp investment, how they, maybe find some kind of a cost structure that works for them. Obviously, they are cutting costs. They are laying off people and restructuring to bring those costs down to become profitable. And that's really what they need to do. Once we see some kind of certainty on that Groupon can be profitable, that it can monetize this SumUp investment, those shares are going to be much higher, $15, $20 a share easily on that. I could easily see this market share or this market cap doubling here to 600 to even $1 billion when we get some kind of certainty that the company can stop its cash burn and stop that. So again, I'm still in on the shares. I still do like the company. I wouldn't be putting a lot more money in it. I'm holding the shares on my cost basis, and I'm going to see that play out. For CRM, for Salesforce, I mean, that's one of the long-term stocks. Okay, that's one of those 5 core holdings of my portfolio that I'm holding for the next 20 or 30 years. Okay, Salesforce is a leader in so many of these growth industries. This AI, robotics. A lot of the growth things. The AI that it has for its human resources and customer relationship management is just amazing. So I'm holding Salesforce. I think they did really well last week, I believe it was, in their earnings, and so I like Salesforce as well. A lot of brokers here in Europe do not accept me because I'm U.S. Connor says he's a U.S. citizen living in Ireland. A lot of brokerages here in Europe do not accept me because I'm a U.S. citizen. Why is this? Also, if any accept U.S. citizens in Europe. I mean, a lot of times it's the same thing with people living in the U.S. that aren't citizens here, or people that want to invest in the U.S. platforms, right? The U.S. platforms like E-Trade and things like that. You have to have a social security number, and it's a big problem for a lot of investors. You just kind of have to find a solution. You have to find a platform that you can get on and invest in some of these stocks. And it's a lot of it is just because of that those kind of know your customer rules, regulations around stock trading and investing. You might try Toro or eToro, I guess it is. eToro is an international platform that open to a lot of people, so you might try that one. Or just open a U.S. account. If you're a U.S. citizen, you can open a U.S. a brokerage account. E-Trade, Webull, a lot of these other ones I use. I use M1 Finance. I use E-Trade. I use Webull. What else? There's a couple of there's Moomoo that isn't too bad, depending on what you want to do. But a lot of those U.S. brokerage or U.S. Platforms that you can get on anyway. Okay, what else? What about Alibaba? So Jay Santos asked about Alibaba. Covered that a little bit earlier. Again, those e-commerce stocks, Alibaba and Amazon, both very low valuations on very good deals right now. We're gonna get Alibaba's earnings here this week, and we're gonna have to see what they say about Singles Day last week. But really about with those Chinese stocks, it is all about the COVID restrictions. If they do come ease up off of those, and what the American auditors say about the accounting firms in China, and if we get some kind of certainty that those companies will be continue to be traded on the U.S. exchanges. So that's really what's going to be driving those Chinese stocks even further than whatever they say about earnings and sales. That's almost a second thought on those stocks. I do own shares of Alibaba. I hold those. It's the only Chinese stock I own right now, and probably the only one I would consider holding. But I do like Alibaba. What about Meta? So Ken wants to know about Meta. A reviewer actually laughs at that. LOL. Meta has become kind of a punchline to a joke lately, right? But it is, you got to look at what it is. It is still the undisputed leader in social media. Okay. And what I'm saying here is not only Facebook, but Meta owns Facebook. It owns the WhatsApp messaging app, which is huge internationally. Okay. We use it here in the US, but the WhatsApp is like the way people communicate in a lot of countries. Okay. So they've got WhatsApp, they've got Instagram, right, which is still the most used and most downloaded app. So Facebook, what you get with Facebook or Meta is really something more than what you get with most of those social media stocks. If you buy shares of Twitter, you can't buy shares of Twitter anymore, but if you buy shares of Snap, right, you only get Snap. You only get that one platform. Okay, so they've got no diversification. They've got no other diversified revenue sources. With Meta, you're getting all those platforms. You're getting while it hasn't been proven yet, you're getting the metaverse potential, that they're developing. And a lot of people like to laugh at the metaverse and what Zuckerberg is showing, and the fact that people don't have legs evidently in the metaverse, which I don't understand why you can't just develop, some legs for these people. It's completely stupid. But a lot of people look at that and they laugh. But, if you've tried those Oculus goggles, I mean, those things are intense, and they are providing some pretty good experience in some of these games, right? They do have some games, tennis and things like that with these Oculus goggles that is very realistic and gives me no doubt that we are heading in that direction. Okay, we are heading in the direction of a metaverse of that Web 3.0 or 3.0. And, okay, so it's a punchline right now, but Meta is really, positioning to be a leader in that, and I think they can pull it off. So, it might be a year or two of weakness as they're spending more and more to develop that metaverse and those metaverse plans. But I think Meta is going to have the last laugh. I think they're going to do really well. I own shares. I bought shares after the last earnings release when it just tanked, when it lost like 24% of its value. That's the point where I said, hey, I'm getting Facebook, I'm getting Instagram, WhatsApp, I'm getting a strong business here, strong social media sites. Plus, I'm also getting that metaverse lottery ticket that I don't think is priced into the shares just yet. So, I own shares of Meta. I think it's going to do well, and I think you can buy in at this point. What else? Paul Fiedler wants to know about 5 to 10 year future of oil. Again, just covered that a little bit ago. I think 5 to 10 years out, you have to be worried about oil. Yes. As electric vehicles do start becoming a larger market share of the market, I think right now electric vehicles are only about, it's less than 5% of the car driving market, right? So you really got to worry when that becomes 20, 30, 40, 50% of the market. And some of these other alternative fuels actually grow into their own and really have that demand destruction for oil. So 5 to 10 years out in oil, I think you got to be worried. I think what we're seeing, though, again, with these oil companies, they are looking, they see that same picture that you do, and they are pulling back on their production spending, right? So as the demand for oil falls, you're also going to get less oil production. Okay, so you're going to see that supply demand kind of stay static, and that's going to support oil prices, right? Now, I can't say 5 years down the road what it's going to look like, but I know, this 1 year, 2 years down the road, I think you're still going to do very well in these oil stocks. Okay, I'm at a target. What about BJ earnings report as they utilize gas and energy? Really can't tell you much about BJ's. I'm assuming you're saying BJ Wholesale. I don't know what you're talking about there, but I really couldn't tell you as far as that one. What else here? Vanguard just loves all the everyday dividend stocks. Oh yeah. Too soon for coin. Okay, so Manuel, good question. Too soon for coin. Okay, so Coinbase, the stock. I got to say, if you've been watching the channel, really over the last year, really since the IPO for Coinbase, I've been warning against Coinbase. I do not like the platforms for investment. Obviously they've got their own problems for being able to hold customer cash or customer funds and things like that. That's totally separate. But as far as these platforms for investment, especially Coinbase, I mean, it's like if you're going to invest in Coinbase, you might as well just invest in the cryptocurrencies themselves, okay? Because Coinbase needs the cryptocurrencies to do well. Okay? If Bitcoin doesn't go higher, if Ethereum doesn't go higher, Coinbase isn't going to be around. That's just a simple fact. Okay, Coinbase, all it does is cryptocurrencies, so it needs cryptocurrencies to come back, and it needs investors to come back. Okay, but that's not necessarily true in the reverse. Okay. Cryptocurrencies could explode higher. Coinbase is going to do okay, but it's not necessarily going to explode higher. And that's because all the competition out there. Okay, Coinbase is just one of many, many platforms that you could buy and sell cryptocurrencies on. So cryptocurrency could go up. Coinbase, if it's not competitive with its rates, with its fees, if it doesn't start new products that people can make, can make money off of or invest in or whatever, it's not going to do well. So you're kind of a lopsided kind of trade-off here. So why not just invest in Bitcoin? Why not just invest in Ethereum and hold those and find some other stocks to invest in? Okay, because Coinbase, I got to tell you, Coinbase, I used to have an account on Coinbase. I moved all of my money out, quite a while ago on Coinbase. Because it's just higher fees. Coinbase has some of the highest fees in the market for cryptocurrency trading and things like that. And I think it's going to be a real problem for them, because what happens when we see in cryptocurrency, we've already started seeing it. I think it was Fidelity went to a no-fee cryptocurrency per investment, something like that, a few weeks ago. One of the big players, I think it was Fidelity, that started lowering their costs of trading cryptocurrencies, of buying cryptocurrencies, right? What happens when we see that? Same thing we saw in stock trading. Okay, when I started investing in 1999, Marine Base, Parris Island, South Carolina. When I started investing, $5 from Brown and Company, the platform, was a huge deal. Before that, it used to be $15 a trade. It used to be $20 a trade through Schwab and some of these other platforms. $5 a trade was huge back in 1999. Of course, Brown and Company eventually got bought out by E-Trade, and that's why I have an E-Trade account now. But now, zero is the average for stock trading. Okay, you don't pay a commission on when you buy a stock. Okay, and that's going to be the direction that investing in cryptocurrencies has to go. Okay, there are no longer going to be these very high fees that you have to pay on sites like Coinbase and things like that. So Coinbase has to find a solution to that, or where is its revenue going to go? Okay, so that's the thing that worries me about Coinbase is they are some of the highest fees around for investing in cryptocurrencies, and that transition to zero fees for cryptocurrencies is coming, and it's going to destroy the revenues further. And are they ready for that? I don't think they are. So I would much rather, if I'm going to be investing in that cryptocurrency theme, invest directly in the cryptocurrencies. If you don't want to invest directly in the cryptocurrencies, buying Bitcoin, buying Ethereum, you can buy the funds, the ETFs. The BITO, which is the Bitcoin fund there, or the GBTC, another Bitcoin fund. You've got Ethereum funds. You've got things like that actually hold the funds, the ETFs that actually hold those cryptocurrencies, without having to set up the accounts and things like that. Okay. What else? How about Microsoft? I honestly haven't looked at Microsoft in a while. I know it's terrifically expensive. We can look back at the price to sales on Microsoft. That's the thing. So MSFT, Mr. Softy, Microsoft Corporation. The company there's no arguing with Microsoft as a company and as a product. I use a PC. I use Microsoft Excel and Word and all those products. It's a great company, but I just can't bring myself to pay this kind of a price for the shares. If you look at Microsoft Corporation, the sales price to sales here, 9.15 times on a price to sales basis. That is high growth stock valuation. Okay, and yes, I understand. Microsoft is looking like a growth stock. It is. They've got that cloud business that is booming. They're doing very well on a lot of their other businesses. But Microsoft doesn't strike me as a growth company. Okay, if you look at quarterly revenue growth year over year on the last quarter was only 10%. That is not growth stock material. Okay, just the size of the company, the market cap. It's very hard to grow a $1.8 trillion company as a growth stock. Market cap of $1.8 trillion. It's hard to grow 20-30% a year in revenues, which is what a growth stock has to do. So if you ask me to pay 9 times on a price to sales basis, for Microsoft, I just can't bring myself to do it. I'm sorry. I'll use their products, but I'm not going to buy their stock at that price. Now, if I will say if this came down to 7 times, 6 times, 5 times, I'd have to take another look, because yes, it is a good company, but I just can't bring myself to pay that kind of valuation for Microsoft. What else do we got here? What else? Investing in banks and financial sectors. Okay, so Terry wants to know what about where is it? What about buying banks? I lost it here. Terry, where is your question? Okay, what about investing in the banks and financial sectors now, or wait until the Fed pivots on that rate increase? This is actually the I believe this Friday's video. I think I'm jumping the gun here. This Friday's video is covering those bank stocks, covering the financial sector. All of you out there in the nation, I've been watching the banks, I've been watching the financial sector all year. I've been positive on it all year, just because think about how those banks make money. They make money on those loan rates, right? And as those loan rates are going up, they're going to make more money. The problem with the banks that we've been seeing over the last couple of quarters is, everybody's worried about a recession, so they're taking money off of that income statement, off of their earnings, and putting it in that loan loss reserves provision. Okay, it's the same thing we saw in the pandemic in 2020. They moved tens of billions of dollars off of their earnings, depressed their earnings, and loaded up on this cash what if account. Well, what did we see in 2021? Bank stocks, the financial sector, the KBE ETF did 126% return in 2021. Amazing, huge return that you don't usually see from the financial sector, right? An old, mature industry. You don't see that from the banks. did 126% return in 2021 because of that. And I think we're going to see the same thing here over the next year, over the next 2 years. We're going to see the bank stocks doing very well as they realize that, the recession, we are going to have a recession, but it's not going to be quite as bad. It's going to be a moderate recession. They're going to bring a lot of that cash what if account, those loan loss reserves back onto the income statement. That's going to support their earnings, and they're going to do well. Okay. So I am investing in bank stocks in the financial sector. I think, historically, even, into a new bull market, the financials are the first sector to really rebound in a bull market. Okay, so if you do think that the bull market is here, that that we are heading towards better times economically, then the financials are one of the best sectors to be in. All those interest rate sensitive sectors are the ones you want to be in. And why that is, of course, again, think of how banks make their money. They make their money on those long-term loan rates, right? They give you money for your deposits, basically nothing right now. But then, they loan it out at those rates. Well, right now, that yield curve, so the long-term rates, the 15, the 30-year mortgage is pretty much right around the same rate as the short-term rates, right? The 2-year, the 3-year rates. So they're not really making much of a difference on those, quite as much as they should be. Well, what happens when the economy does start rebounding? Those long-term rates stay high, the short-term rates come down a little bit. So, you've got a bigger slope on the yield curve. What we do see is, I think it was either Goldman Sachs or I think Bank of America last week had their earnings, or a couple of weeks ago had their earnings. Of course, moved hundreds of millions of dollars onto their loan loss reserves. That meant earnings were down a little bit. Excuse me. I think Bank of America had a 9% drop in earnings over the last year, is what they reported. If it hadn't been for that difference in loan loss reserves, last year, same quarter, they moved $1.1 billion off of their loan loss reserves into earnings. So that artificially increased their earnings. 2021, again, a great year for the banks. Now it's depressed their earnings. So it was actually about a 20% drop, relative in their earnings. They still did really well, reported a 24% increase in their net interest margin. Okay, that's that net interest margin. That's the interest margin. Think about that. The difference between what they get on their loans, the rate they get on their loans, and the rate they're paying for those deposits and other sources of financing, right? 24% increase in that net interest margin account. So, they are doing very well. The banks are doing very well. The only thing is, the fear of a recession and how much money they're moving off of their earnings into that cash account. But they still have that money. So yes, I do still like the banks. I still do like Bank of America is very good for that commercial lending part. Goldman Sachs, valuation as low as I've ever seen it for Goldman Sachs. With that, you get the capital markets exposure. Probably not as strong over this next year, as the capital markets are still very weak. Investment banking and debt issuance and mergers and acquisitions going to be very weak over this next year. So capital markets types banks like JP Morgan, like Goldman Sachs, like Credit Suisse, very weak probably over this next year. But you still have such an upside from the other part of the business, that commercial lending part of the business, that is going to that's going to hold up those stocks, and it's going to be very good for the commercial banks, right? So your Bank of America's, your Wells Fargo, your Regions Financial, those pure commercial banking lenders, those are the ones that are going to do best, and those are the ones I think you want to focus on with those. But again, video coming out this Friday on that. The banks I'm adding to the bow tie index. Be sure to watch for that. Okay. What else? Victor wants to know anything to say about Tesla. All you out there in the nation know I don't talk about Tesla much because it's one of those that it's just perennially too expensive for my taste. And again, I have no argument that Tesla dominates the electric vehicle market. It is, it could dominate the self-driving taxis market. But it is just very expensive. What obviously worries me about Tesla is Elon Musk. Okay, and I know a lot of people love him. You think he's the second coming, the Messiah or something, but the guy has just gone off the ledge with Twitter. Okay, what makes Elon think he can run Twitter, Tesla, the Boring Company, SpaceX, he's just got too much shit he's got to worry about on a day-to-day basis. I think if he could focus on just one company, if he could focus on Tesla, the sky would be the limit. But how far can he go? How far can he push himself? So that's kind of what worries me about Tesla. What you got to understand about Tesla, folks, is when you see these huge stock price targets by ARK Invest. Kathy Wood at one point had like a $4,000 price target on Tesla. Of course, they've done some reverse splits and stuff, or some splits in the meantime, so that target's down a little bit, but her price target for Tesla is still up here, right? A lot of price targets for Tesla, they come under the assumption that within the next year or two, Tesla is going to have a fully functional self-driving automated cars, and they are going to have some kind of a taxi service, right? That if you look at the ARK Invest price target for Tesla and why it is so high, 50% of that valuation comes from just that part of the business, having the robo-taxis business, okay, and taking all that market share away from, Uber and Lyft and regular taxis and all that, right? So what happens if that doesn't happen? What happens if that gets pushed off like it has so many years in the past, but gets pushed off 3 to 5 years? That really brings that valuation target down on Tesla. So I think, it is something to be watching in the future. I do think they do very well in that robo-taxi environment, as well as obviously the electric vehicles. But, just over the last year, we've seen a lot more competition from the legacy car makers like Ford, like GM, like Toyota in those electric vehicles. I think they start eating into the market share for Tesla. And, and I think you got to worry about the valuations on the company. That's what I've been, why I've been staying out of Tesla shares for the longest time. Yes, I've missed out on some of the returns there, but that valuation just worries me when they do have to compete more fully in that market. Okay, future Bitcoin. JP wants to know about the immediate and intermediate future of Bitcoin. So again, I do like Bitcoin. I do like Ethereum for the long term. Intermediate term, I guess you could say. Immediate, we have not seen all of the effects of that FTX implosion. I think we will see, other platforms close, other platforms shut down. We will see, more weakness. I think probably a lot of that is already built into the price, of Bitcoin and of Ethereum. So we are, I think, last I checked today, we are seeing a little bit higher prices for both of those. But I think, you got to come back to the basic reasoning for these two tokens. Again, we're not talking about all these other tokens that have no basis in use, but the use case for Bitcoin, the use case for Ethereum is in that blockchain technology that is not going away, that is really doing some great things for different industries like healthcare, healthcare records keeping, for technology, for transfers, money transfers, things like that. That use case is not going away, and it's only going to develop more. Okay, so the need for these tokens as a validation in that blockchain ledger isn't going away. It's only going to grow. So, intermediate, I still hold my targets for higher Bitcoin, higher Ethereum. That's why I still own those. Other than that BlockFi money that I have got, locked away right now. Hopefully that gets unlocked. But other than that, I do own the ETFs for Bitcoin and Ethereum. That's BITO and GBTC for Bitcoin. For Ethereum, I believe it's ETH. Ethereum, the Ethereum, the Grayscale Trust ETHE is the fund for that. So easy way to hold Bitcoin and to hold Ethereum without having to hold it on a platform like Coinbase, like BlockFi, like some of those platforms. So a little bit, it's a more secure way because you're holding it directly through the funds. You can also hold it in a cold wallet, which I do own some money, some Bitcoin and Ethereum in a cold wallet. It's not a whole lot, but I own some of that in those as well as some futures for those. So, you have to look further out. You, again, have to limit your exposure. Again, folks, we come back down to that idea that never have more than 5 or 10% of your money locked up in any one single investment, any stock, any company. And I think that goes for Bitcoin and Ethereum too. Do not have more than 5% of your money in either Bitcoin or Ethereum. I think you can have upwards of 10% total of your money in both of them. But to have any more than that, it's just going to have that risk of just panicking when these market crashes do come along. Okay, so K-Biggs does say BJ Wholesales. I really haven't covered BJ Wholesales, haven't looked at it, so I really can't tell you one way or the other on that. What else was favorite option strategy? Cameron Vincent wants to know favorite option strategy. Have done an options video on the channel before, my 5 favorite option strategies. So if you go to the channel, go to videos and search, do the little search for options, you'll find that one. It's a great video, one of the most popular on the channel. Favorite option strategy, probably just the covered call strategy, right? I am very much risk averse. I am very much into the idea of using options to hedge my risk. I know over the past couple of years, a lot of investors have been pulled into that speculative investing for options, trying to make more money, trying to leverage their money even further. And a lot of investors love it. I just don't, I got enough risk in just investing in stocks alone. Okay. Right. You can make plenty of money just in stocks. I don't think you need options to amplify your returns any. Right, because there are a lot of risks inherent that people just don't understand with options. So basically with options, I use them as risk hedging, to bring my risk down. Okay, so I'll sell covered calls. I'll sell call options against some of my stocks that, when I want to take some profits or off there, but I don't want to sell the stock. Very good example. Lately into this bear market rally, as stocks are heading higher, then I'm taking some risk off the table by selling some of those call options against some of those stocks, trying to cash flow those stocks. Some of the stocks like the oil stocks, CVX that I hold, Chevron, I've recently sold some call options against that. I do like energy stocks over the next 6 months to a year, but they're getting a little pricey, as they are right now. So I want to sell some risk against that. I want to de-risk a little bit in that, but I still want to collect the dividends on that stock. So, a great way to keep on holding the stock, but take some risk out of it a little bit with that covered call strategy. It's one of my favorite ones there. Okay. Any good dividend ETFs that I've been tracking lately? Ashish wants to know good dividend ETFs that I've been watching. I mean, for dividend ETFs, you can't beat the SCHD, right? The Schwab dividend ETF, their ticker SCHD. It's really, for my money, the best dividend fund out there. It's not a high yield dividend fund, but it is going to give you that combination of good price return plus those high dividends. So SCHD is the one I use. I do also, some of the other ones, I think this the DIGO, I want to say, is another one that's a good dividend, a higher yield dividend fund. And I know that's not it, but what else? What am I thinking here, folks? The DIGO, that's not it. Nope. The dividend, it's the high yield dividend fund. Let me just go. If you want a great resource for ETFs, go to your Google here and type in dividend ETFs, and you can do this with any ETF, okay? Any kind of ETF, growth ETF, dividend ETF, just type it in here in Google and look for the ETF database, etfdb.com. There you go, etfdb.com. You click on that, and it's going to give you a list of all the ETFs in that segment, right? Growth ETFs, dividend ETFs, whatever it may be. You got the menu here. You can sort by returns. You can look at expenses. Very important there to see what expenses they're charging. The dividends. Okay, if we go to dividends here, we can we get the annual dividend yield. We can sort that to find the highest dividend ones. The SDIV is a good one here. The Global X Super Dividend ETF. Very strong dividend yield, 7.7%. So that's one I've held in the past. Let's find the one I was thinking about. Which one was that? The DIV, the Global X Super Dividend ETF, US ETF. That's a good one. Ticker DIV. That's one I've held in the past. The SPYD. What else have we got? Scroll down and see what's interesting here is we still haven't seen the SCHD. So, I mean, yes, it isn't the highest dividend yield, but it does give you a very strong dividend yield plus that price appreciation, which is really what I'm looking for. I'm looking for a combination of that dividend yield and the price appreciation. So, SCHD is the one I use quite a bit. I think that SDIV is probably your best bet for a high dividend yield stock. So you got this Global X Super Dividend ETF, SDIV, pays a 7.7% dividend yield. It's not going to give you the price return that you get with the SEHD, but it's going to be the higher dividend yield. Yes, DGRO. Okay, Vitaly, thank you. DGRO is the other dividend fund that I like. The iShares Core Dividend ETF. So that's and again, thank you Yahoo Finance for being a moron and taking the dividend yield out of these. Yeah. You can no longer see the dividend yield on the main page of the Yahoo Finance. So again, somebody call up Yahoo Finance, tell them to take their head out of their ass and put the dividend yield back on the main page. Maybe the profile for ETFs. I gotta assume you're looking at the profile page. No, and we got to find where we can find the dividend yield for these ETFs because this is insane that you can't see it on the main page anymore. But again, so good one. So yeah, SEHD for dividend funds. The SDIV at DGRO is a good one as well. What do you think of tech stocks in 2023? Ramesh wants to know tech stocks in 2023. Again, as we talked about in that in the main topic today, while I don't think we're done seeing a sell-off in the market, I don't think the bear market is over. We are getting very close. Okay, February is what we're looking at for the end of the Fed rate hike cycle. So I think as we get closer to that, we get more confident that the bear market is over. So I'm looking at December, January for the maybe for a market bottom or for a retest of some of those lows. And after that, it is going to be the stocks that have been hardest hit that are going to rebound the fastest. Okay, so like those tech stocks, like the internet stocks and the social media stocks in the communication services sector. I think you can start looking at those even more in here December and January if you haven't already. Again, myself, I'm using that barbell strategy, so I'm already in a lot of those tech stocks, a lot of those growth stocks in that part of the barbell, as well as still having some growth, some cash and some safer stocks and safer investments here in this other part of the barbell. Really gives me the best of both worlds with the growth plus the cash set aside to take advantage of those other opportunities. Reviewer wants to know a question for predicting SoFi long-term success. Can never predict something, but all you out there in the nation, all you watching the channel, I love SoFi. SoFi is one of my largest stock holdings. That's ticker SOFI. That's SoFi Technologies. It's a basically an online bank. And why I like SoFi is because they have that banking charter. So many of these other fintech companies, these other online banks, so to speak, like Ally, like whatever they are. Well, I think Ally might have a bank charter. I'm not sure, but most of these fintech companies, these online banks, they don't have a bank charter, right? So they can't actually take deposits. They can't have savings accounts. They can't have checking accounts and all these other products that you can do with a bank charter. Okay, with a FDIC insured bank. Okay, SoFi has that. So what SoFi is able to do, it's able to have savings accounts and take deposits, and that gives it the funding. That gives it the funding source, all the funding it needs to make those loans. Okay, which is its core business, just like any bank. Okay, so yes, I do like SoFi. I think it's it's very underpriced right now. So I think you can both buy SoFi and have it one of your strongest growth stocks over the next 10 years. What else here we got? Joseph, SCHD, quarterly dividend. Yep, great stock there. Lifters Gym, they're Chad. They're in Albemarle. I know you always give me shit about mispronouncing that, but dividends still showing up on the app. Oh, okay. So evidently Yahoo Finance, you can still see the dividend yield in the app on Yahoo Finance on mobile. But since I am an old timer, I use desktop and I hate this new Yahoo Finance. It's going to become exclusively associated with people with crap credit. Thank you for chat. What about Nikola? Okay. So Terrence wants to know about Nikola, the electric vehicle producer. I mean, with the electric vehicles, again, folks, you got to understand, I am a risk averse person. Okay. I am not going to take the biggest risks out there. I'm not going to make the biggest returns on that account, but I am just happy with, taking the risks on some of the growth stocks that I like, but not stepping so far out on the ledge that I might fall over. Okay. So that keeps me away from some of the stocks like Nikola, that you never quite know. Okay. Could it have a place in the future of electric vehicles? No doubt. It could, and it could do very well. But if I'm investing in electric vehicles, I'm going to stick with the known quantities, right? I'm going to stick with the legacy automakers like Ford, like GM, like some of those we know, maybe even Tesla, if the share price eventually comes down to a price I can manage. But yeah, I'm not really looking at Nikola and some of those others that you got to worry about management. You got to worry about their cash burn. You got to worry about so many other things. Okay, so Scott from South Carolina says SoFi was hurt by student loan deferment. Yeah, SoFi Technology, SoFi actually started out as a student loan company, right? That was their sole purpose, was us refinancing student loans. They've shifted into more of an altogether bank, a holistic bank experience, but they still do have a lot from that student loan segment of the company, and that's hurt. That's hurt all year with those student loan deferments. We will eventually, we got to start paying our student loans eventually, folks. That's just how it is. When the government stops playing politics with this and starts saying, hey, look, folks, pull up your big boy britches because you got to start paying back your loans, then that's going to be a big bonus, a big plus for SoFi. So I think you're going to see the shares jump on that news, that announcement that, this is the last deferment for student loans. But in the meantime, they're still doing very well on the rest of the business and are going to continue to do well. Cloudflare, Alex wants to know thoughts on Cloudflare. One of my favorite tech cybersecurity stocks. There's very few industries that have that growth that cybersecurity or the stability that cybersecurity has. Okay, if you look at a lot of the growth stocks, obviously Teladoc, SoFi, a lot of those growth stocks, growth industries have just taken a hammering over the past year. But cybersecurity has done pretty well, and it's just because of that stability and that demand for cybersecurity software and for companies. And Cloudflare is one of the stronger ones, one of the best to breed ones. It's one that we own in the Bowtie Index. It's one I own myself, and it's one I think you can like. What else? So Mark Pro Trucks, I guess that's in response to Nikola. And yeah, if Nikola can pull up its pull up its game on those trucks, then the commercial side of electric vehicles is really where we should start seeing this first. But they just haven't been able to do it. I made changes that okay, problem with electric, they catch fire. They catch fire too easy. That could be something too. Obviously something to watch out for. What else? Frank Walker Law wants to know thoughts on QYLD. You got to know what I think about QYLD. Come on. I've got quite a few videos out there. I used to invest in QYLD, was, drawn in by that 10% plus dividend yield, but then you look at the stock price and it just broke my heart. Okay. QYLD, I can show you the chart here. If you don't know what we're talking about, that's the NASDAQ covered call ETF. NASDAQ 100 covered call ETF, ticker QYLD. Again, you don't see it here, but the dividend yield is upwards of around 12%, I think. And a lot of investors love this. A lot of investors love this for that dividend yield. It's a monthly dividend stock too, so you get that payment every month. But if you look out here, if you ever want to sell that stock, you're going to be hurt because the stock price is just perennially going down. Even in the best of times, it is going down. If you look at comparison, if you compare QYLD with just the NASDAQ 100. So what this company does, it invests in the 100 stocks in the NASDAQ, the 100 largest index or stocks in that index, those tech stocks mostly. I invest in those and then sells covered calls against those to cash flow and pay for that high dividend yield. But if you compare owning the QYLD with owning just shares straight up of the NASDAQ, that QQQ ETF owning the NASDAQ, you make good dividends, but you would have just been much better off 5 years, over the last 5 years here, you would have had a 66% return. Even after the crash of this year, you would have had a 66% return in shares of the NASDAQ, okay? You would have lost 32% in shares of the QYLD, okay? You go even further out and, it's even more, right? See if we go to yeah, it's not going to show us there the max, but yeah, you look at 2 year, you look at pretty much any time frame. Over the last 2 years, you would have lost 25% of your investment in the QYLD, just 4% on the NASDAQ. Of course, the response to that is that everyone's saying always, well, I'm never going to sell my shares, so why do I care if the price goes down? Well, the problem, folks, is be realistic here. Look at your portfolio. Have you held any of those stocks more than 2 or 5 years? Okay, even at the most investors, data from the NYSE says that investors are holding their stocks for 5.5 months on average. That is, historical low. But even that, so you got to really question yourself. Are you going to hold that forever? Are you really going to hold that stock forever? And what happens when you do try to go sell those shares and you're getting, 25% less than what you paid? And what does that mean for the dividends you collected? Okay, those dividends you collect, unless they're in a retirement account. So the only way I would hold the QYLD is in an IRA, in a 401k if you can, in a retirement account, so you don't pay taxes on those dividends. Otherwise, every single year, you're paying taxes on those dividends, on that 10% yield. So not only are you getting hit each year by paying taxes on those dividends, but eventually you're going to take a big hit on the stock price as well. Again, used to invest in the QYLD, fell out of love with it, and now I invest in just, basic dividend ETFs, monthly dividend stocks, and regular dividend stocks because, the QYLD just has not held up its part of the bargain, okay? Got a couple of videos on the channel, dividend stocks that are better than QYLD, monthly dividend stocks that are better than the QYLD. Look for those, and you'll see what I mean with those. I know I'm breaking a lot of hearts here, talking shit about the QYLD. I know a lot of people still love it, but hey, you got to look at the facts. You got to look at what that actually is. Susan Andre, the Bowtie Index. Tell me more. The Bowtie Index actually really exciting. We just started this partnership with ETF, an ETF provider, and StockCard. If you go to stockcard.io and you go to the Idea Center. This is how you find it. Go to Idea Center, go to indexes. This is the first index they're launching was the Bowtie Index with us. Here you click on that. And this is I put together this index. This is the 50 stocks, the 50 best of breed stocks there. Basically I took the S&P 500, not supposed to say that because we're not paying the S&P for their licensing to use that name. So I'm just going to say the top 500 U.S. listed equities, right? The largest 500 stocks in the U.S. markets. Took that and, I used these. I'm showing you everything I did here in this page. You can see exactly what I'm doing to pick these stocks. The quantitative factors, right? Sales growth, 1 year sales growth, 3 year sales growth versus the industry. Operating margin 1 year and 3 year versus the industry, the PEG ratio, as well as these qualitative factors. All these factors that I'm using to pick out the 50 best of breed stocks in each, across the market, right? And what I'm doing here, you can watch some of these videos that we posted because I really go in further in depth on, how this methodology is working, how we're using it to pick stocks. And you look at, you just look at back-tested results. We bought these stocks we started the index in July of this year. You can see all the constituents here. We bought those in July of this year, started the index, but back-tested results over the last 5 years, it would have beaten the SPY, the broad market index, by about 50%. Here it's actually about 70% now because it's rebounded quite a bit over the last week. But would have beaten the market by about 50-70% over the last 5 years because these are the best of the best in each industry, in each sector, okay? You watch some of those videos, watch how I explain how I'm picking up stocks for that index. But this is an official index. It's not traded yet. It's not an ETF. We hope someday that we might be able to create an ETF off of this so you can invest directly in the index. But right now it's just an index. It's ticker BOWT. So, if you have an index provider where you can look up indexes, then you can find it there. But it's not an ETF yet. But you can see exactly how we're picking up stocks. I'm doing a weekly video on stocks in each sector, and you can see the individual stocks right here on Stock Card. So go ahead and click through that, find that on Stock Card, and that'll show you exactly what we're talking about. What else? What else are we looking at? Thanks for the feedback. I do believe JEPI is probably a stronger way to get options income. Okay, so Hulin talking about the JEPI. That's another one of those covered call strategies. I mean, it's been a while since I've looked at some of those covered call strategies. The QYLD is the one I'm most often looking at. But the JEPI is set up pretty much the same way. So you got a lot of those, but the problem is, a lot of those, they're always going to underperform just the basic index holding. So, I mean, if you want, you could replicate the strategy on your own. Just buy the QQQ, that's the NASDAQ 100 ETF, and then sell covered calls yourself. So really, you can do the same thing as the QYLD. Save on those fees, right? Because if you hold the QYLD, you're also, not only are you underperforming the market, but you're also paying those management fees. You do it yourself. So not only are you saving on the fees, but you're getting that cash flow and quite possibly even beating the QYLD at its own game. Thoughts on GLD with the USD dropping. Okay, so Santiago wants to know about the GLD. That's the gold trust there, right? The Spider Gold Trust. So for gold shares, we go to the chart here. GLD. Yep, Spider Gold shares. So basically, it's a play on gold, right? How to invest in gold without actually owning physical gold. So two things here. One is just the price of gold. Okay, the price of gold is always going to be a factor of a few things, a function of a few factors, right? One is the U.S. dollar, right? Since it is priced in U.S. dollars, all commodities are priced in U.S. dollars. As the dollar increases, the strength of the dollar, then that's going to weigh on a lot of these commodities. We have started to see that the U.S. dollar is weakening. From really a 20-year high against a lot of these currencies. So the dollar is weakening. That is an upwards support for gold prices. The problem with gold though is another function or another factor there is those interest rates, right? As you hold gold, you earn nothing until you sell it. You earn no yield on gold. So the problem is with these higher interest rates is that investors can just earn a higher yield on something else, on a bond or on a lot of these yielding investments. Okay, so that is really drawing people out of gold at that point as those interest rates go up. So that's obviously going to hurt the gold prices. If we get some of this uncertainty out of the market, that's obviously going to weigh on gold prices as people get drawn out of those safety sectors and into stocks. I'm just not a big fan of the gold price here. It is down to 164 per share on the GLD. That is around the lower end of the range over the last couple of years. So I don't think it's going to fall quite a bit further. So if you really like gold, this is a place where I think you can start kind of buying shares and being a little bit more confident on that. But I would actually rather see, you invest in gold miners, right? Rather than the gold itself. If you look at the gold miners, so ticker GDX is the ETF, the gold miners ETF there, VanEck Gold Miners ETF, that's ticker GDX. And, again, beautiful Yahoo Finance. We cannot see the dividend yield here. Somebody put the dividend yield for GDX up on the screen there. But, we could go by the historical data, or as I hear, it's in the app. If you're using the mobile app for Yahoo Finance, you can see the dividend yield there. But basically the idea here is if you own the gold miners, you're getting that dividend. If you own any of the gold miners individually, that Newmont Mining, the Agnico Eagle gold shares, you're getting that dividend yield while you hold gold. Okay, so it's a way to hold gold and still get that yield, still get that return. For the gold miners, they're still cash flow positive. I think most of the miners, they're all-in sustaining costs, so that AISC is right around $1,200, maybe $1,300 an ounce. So as long as gold is around $1,700 an ounce, then they are still cash flow positive. They're still making money to support those dividends, support those share buyback programs, and support earnings. So, if you like gold, then I would much rather see, in the ETF, the GDX, their gold miners GDX, to get that dividend yield and to get that upside on the leverage for the gold miners, rather than just gold itself. But but yeah, gold prices have come down because of the interest rates coming up. So I don't think you see too much more downside on the gold prices themselves. What else? I'm gonna call. Already ready for a bow tie ETF. I mean, that would be, that's really what we're trying to do with the bow tie index is launch that ETF, be able to have a direct investment in those 50 best of breed stocks in the market. But that's going to be a few months anyway. Pinali wants to know about PayPal. All you out there in the nation, I like PayPal. It's also one of my larger holdings. I started buying it in January of this year. I think my total cost basis, I'm about 26% down right now on PayPal since I did start buying it in January. Look, PayPal, it's not, there is competition out there, but it is the undisputed leader for payments, right? It is hard to get around PayPal. There's obviously their fees are a little bit higher. I still use PayPal though. I know most of the people I know still use PayPal. It is still accepted on so many sites. I think PayPal just announced a deal with Amazon to use the Venmo app. It's Venmo wallet app on Amazon. So that's going to be an upside. Basically what I'm looking at for PayPal here is it is a leader in that growth industry of online payments, right? E-commerce payments. It is a leader in that industry. It's a leader in digital wallets, which is going to be the surprise industry over the next 10 years, I think. I've done a few videos looking at the research in digital wallets. And basically right now, digital wallets like Venmo, like Square's Cash App, they're just like they're not doing much. They're not monetizing these wallets. Okay, they have these wallet users that hold their money in there to be able to buy and sell on e-commerce and point of sale and things like that. But they're not monetizing like they could. They're valued right now at very little as far as this monetization. Well, once these digital wallets develop, okay, what I think these digital wallets are going to create a super app out of PayPal, even out of the Cash App for Square. But these digital wallets are going to become everything. They're going to be selling you insurance. They're going to be selling you. They're going to be a brokerage, all right? So you can do your investments through your digital wallet. You're going to be buying, like I said, insurance. You're going to be doing all kinds of anything financial. You're going to be buying and selling it through these digital wallets, right? So that is just going to be a wave of revenue and upside for these digital wallet owners like PayPal, like Square's, Block, that kind of thing. So that's what I'm looking at PayPal. That's why I own so much of PayPal, and that's why I really like the stock. It's actually in the Bowtie Index. That's one of the stocks in there. One of the stocks that I'll cover this Friday on that on that financial sector. Stocks in the Bowtie Index. So we're getting on 11:09. It's 2 hours into this live stream. I got to get to work, folks. I love doing this Q&A with y'all, but I got some other things I got to do today as well as get to the gym. So thank you for being here. I appreciate it. If I didn't get to your question, go ahead and ask it in the comments. I'll try to get to it while I'm at the gym a little bit later. But other than that, I'll see you in the next video.